One of the most common questions that I get is, Chris, how long do I need to fund my whole life insurance policy? This is undoubtedly one of the more misunderstood questions in the whole life industry. And in this video, what I'm gonna do is I'm gonna cover how long you have to pay your premiums and ultimately the best way to kind of handle it and show you kind of how there's flexibility along the journey and how you can make the best decision that makes the most sense for you and your financial situation. So if you haven't already, make sure you subscribe to the channel and hit the bell, that way you're notified every time I launch a new video, because I'm gonna be really dominating 2023 when it comes to creating educational content in the whole life insurance space to be able to educate more advisors and more consumers to make better decisions and be able to serve more people. So let's get into it. All right, so what's up, Cashflow hackers? It's Chris with Life 180, and for this video, we are covering how long do you have to pay your premiums for a whole life insurance policy. Let's face it, we've all had the conversations. If you're an agent, you've definitely had conversations with people saying, I don't want to be cash strapped have to pay this premium forever. And if you're somebody who's looking at buying a policy, maybe you're thinking that to yourself. Maybe you're thinking, well, you know, I need insurance. I'd like to utilize a lot of the things that Chris talks about from a cash flow hacking perspective, or utilizing my policy as an emergency fund and an opportunity fund, but you know, how long do I actually need to fund my policy for? And so what I did was I took a couple illustrations and I showed a couple different options. Now, full transparency, I think this is really important to understand, and I've covered this in a couple videos lately, but I think it's really important to understand, if you haven't seen them yet, that when you look at an illustration, really that illustration is not locked in place if you are doing a feature like a reduced paid up or a premium offset or anything aside from like a full pay when you're utilizing a full pay product. There are a lot of flexibilities in a policy depending on what kind of base to paid up additions blend that you do. And if you don't understand what that is, make sure you watch this video right up in the corner here to learn more about that, on how to set up and utilize the proper blend for your situation. And you know, there's a lot of flexibility with that, and then there's a lot of flexibility where if you come on hard times and you can't make premium payments, maybe you just don't pay the PUAs for a year. Maybe you need to do an RPU, what we call a reduced paid up, where you reduce the amount of insurance and you pay it up fully, meaning there's not another dime of insurance expense that comes out of everything, right? Like that's really important to understand that that's an option. Now, another option is that you utilize what's called a premium offset, meaning you utilize dividends and growth of the policy to help make the premium payment. So what you can do is you can actually use dividends and a portion of surrender of the policy to help make the premium payment as time goes on. And so once again, you can illustrate all these things, and you know, we can illustrate to show examples for people to really see what their options may or may not look like. But the bottom line is, nothing is set in stone. If you buy a full pay, like with this company I'm going to show you, it's a full pay through age 75, right? So that once you hit 75 and you pay this every year through 75, this policy is fully paid up, right? So it's important to understand that. Some companies do full pays where they're not paid up until 95 years old. Some companies do 120. Some companies actually offer as early as 65 where the policy is fully paid up. A lot of times people are taking what, you know, companies' policies like L95 policies and trying to show them fully paid up at 65, but they're not. They're only fully paid up at 95, and they're trying to show creative ways through RPUs and premium offset or other variations or flexibilities offered by the carrier to show them how you don't have to come out of pocket, but they're not really truly paid up. If you got a pay through 95 policy with a company, you are in some way, shape, or form either going to have to RPU that policy or pay it up. The challenge that I want to say about this, when you utilize RPUing, a reduced paid up feature in the policy, you do lose the living benefits, the accelerated benefit riders that come with the policy when you do that. So that's really a negative. And for most people that I know, even though they say they're not buying it for the life insurance, the death benefit, what they do like is the living benefits that come along with it. Because if you become chronically or terminally ill with some companies, and sometimes it's just terminally ill depending on the company. But with the policy that we're going to look at, it's chronically or terminally ill. If you become chronically or terminally ill while you're alive, you get access to the death benefit for a portion of the death benefit for whatever you want during that period of time. So pretty powerful feature that if you RPU, you lose, and most people don't want to do that. So let's get into this though, because the question, getting back to the point here, is how long do you want to fund it? And once again, this is just going to be based on what you want, what your goals and objectives are, how you plan on leveraging the policy in your life. And I always kind of tell people, don't make short-term decisions to solve long-term problems. And this is a classic example about it. So what I'm going to do here is I'm going to actually share my screen and get to this. And all right, so let's do this. What I want to do is that this is, I wanted to kind of show a 7-pay policy here, right? So the 7-pay policy here, you could see here, we did a $30,000 front load into the policy. We did this because imagine somebody with, I don't know, $30,000 in CDs or $30,000 in savings account, and then they're going to afford a $10,000 annual premium. So just hypothetically speaking, obviously, it's a 40-year-old. You could see at the end of the first year, they're 41. And so we can see here that this person was coming from the perspective of how short can I pay the policy? Now, I'm going to tell you this. There are creative ways that you can get to pay it only for 5 years, that if you do a big enough front load, and you can utilize what's called the premium offset, like I was talking about, to make it so you only pay for 5 years. And what happens there is if you get enough money into the policy early and you do the right base to paid up additions blend, the dividends here and the increase in net cash value every year will pay the premium. You can see here, right here, the increase in net cash value is 11.5, but it's not strong enough because there's not enough money in here. If I had done like 100,000 on the front end for this, I could probably utilize like a premium offset and only pay this out of pocket for 5 years, and then it goes from there. But at the end of the day, that premium offset, once again, comes at a cost, and that's important to understand. So let's take a look at this policy, and then we're going to look at a full pay. I want to go through this and just explain how we did this. So what we did is we utilized a 7-year term rider blend, just a level term rider, and we utilized that term rider to enable us to put more cash into the contract, right? And so you can see out of the $40,000, this is pretty strong. I mean, there was $35,582 in net cash value. And because the term rider is added on, you got $608,524. So you're over $600,000 of death benefit. Now you can see year 2, you're putting $10,000 more premium in. It's growing pretty healthy, almost by the premium amount, and the death benefit is going up by more than the premium amount. So once again, when Dave Ramsey says the life insurance keeps both the death benefit and the cash value, well, as you put more cash value in, the death benefit is growing. So that may be true to an extent from a technical perspective, but obviously there are benefits because this passes on tax in a tax beneficial way, tax-free nature, right, to this. And so then it keeps going on, and you can see here, 7 years, we've put in about $100,000 in total cumulative premium, and you're break even effectively at year 7, which is fantastic because you basically match kind of what would happen in a savings account, and you pick up the life insurance that goes along with it. Now, if somebody says, hey, Chris, I just want this to be a bank account on steroids. I really don't care about the life insurance and so whatever. So we don't really take a look at this life insurance column, even though it's there. And I'm a big believer that even if you don't think you need it, my guess is you want it, and for some reason. I don't know anybody, if you knew you could have access to extra tax-free money in an efficient way, you couldn't find some good positive use for that money. So even if you're not married, even if you don't have kids, my guess is there's some cause in this world that you could leave your stamp and legacy on to be able to leave the world a better place. That's kind of my call to action for you there. But as we look at this, what's happening is now it's reduced, paid up. You can see here the death benefit drops. Now what happens here is the term rider drops off, but also the permanent whole life insurance gets reduced and it's fully paid up, meaning there are no more expenses. This policy is a fully paid up policy. There are no more riders, there are no more features, there are no more benefits. If you look at this for the first 7 years, there are accelerated benefits in this policy. If that person becomes chronically or terminally ill, they will have access to a portion of this death benefit while they are alive. Now, once year 8 hits here and that is not happening, well, that is not the case anymore. They lose those benefits. Now, once again, if you ever see a policy like this, a lot of people misunderstand and they think this is the contractual guarantee in the policy. This is not the contractual guarantee in the policy. This is just an illustration showing what it would look like if you chose that option. So if I, like for instance, if I ran this for you and you saw this and you're like, wow, this looks really good, I want it. Okay, cool, we can get that for you, right? Like you could get this policy set up. Just know that this is not gonna happen automatically. You actually have to go and do this for yourself, or you have to have your agent do it, or you have to do this for your clients, right? When you're selling this, this doesn't happen automatically. It's the importance of working with an agent and with a company that's gonna be with you for the long term, that's gonna really service you and be there to take care of you and coach you and really navigate like understanding what your goals and objectives are. Because let's face it, if you do this policy right now, 7-8 years from now, there's a really good chance that your life's gonna look a lot different than you thought it was gonna look at that point in time. And so you need to be able to navigate accordingly. Now, as this is set up, because of the blend that we did, it's a 40-60 blend with a front load in the policy. So you can pay anywhere from $4,120 in this, because the paid up editions minimum is $120 with this company. So you have to pay at least that $120 to keep the rider available. And you can pay up to $10,000. And they do allow you to make up, but I'm not going to get into the details of how their makeup period works because that's not the purpose of this video. But what you can see here, and I'm going to start going back and forth and comparing the RPU to the full pay, because what you're going to see here is when people ask how long do I have to pay, my point to you is that when you see this, all the fees, all the expenses for this are at the very, very beginning of this policy. Once you get through year 4 in this, or even year 3, you're not going to find another place in the world that will give you the guarantees and the liquidity that this policy will offer you. So my question to you is, why would you ever want to stop, right? The only reason you would ever want to stop is if cash flow stops. And if you're still working, my guess is you still have cash flow, and at that point in time, it makes sense to run your money through your policy, right? And so this is really important to understand. So let's take a look at what this could look like. So year 7, you've got 100,000 going in, you've got 100,652 of liquidity. Now I pop over to the other one. Now you can see this is a full pay policy. Now what I did here, because I didn't RPU it at year 7, I kept paying it. It's a 40-year-old. So what I did is I took the 7-year term rider and I extended it out to year 20 because I want to be able to pay. The full transparency, they offer a 30-year term rider, but in order to do that, I would have to have a term rider going all the way to age 70. That would increase the cost of insurance, and what I found was that had a negligent effect on the cash growth. And what you could see here is after, because of the way the MEC laws work, the premium didn't drop off too badly. So we just kept it like this, and this is just how we had to navigate it to be a non-MEC contract. Now, what I want to do here is take a look at some time periods here. And I'll go back and forth a little bit. Now, year 1 or year 7, you can see you've put, obviously, at that point in time, the same $100,000 of cumulative premium in. That's great. And we have a couple $1,000s less. Why is that? Well, it's because of the term insurance over that period of time. We're paying more for it. We have the same amount of cash that goes in. So over that 7-year period, it's costing us a little bit of money, because when you see you got 710, well, actually, yeah, so it's actually 706 in, but it's because of the fact that this was the RPU was a 7-year period, so it's really, really cheap term because you're only insuring through age 47, whereas this one is going through age 60 on the term insurance, and so it's going to be naturally more expensive per year. That's just the way they price out term insurance, and so that comes into the equation. So you're going to have a little less cash value in year 7. But then by year 10, check it out. By year 10, the RPU policy, the reduced paid up policy, I'm going to go back to it, has 114,000. So once again, you've put in the 100,000, but you got 114 at the end of 10 years. So you can see this starts to grow really, really efficiently. You got 100,000 in, right? And it's growing by a net with no cost, no nothing, 4.5% pretty much right away. Like, that is pretty awesome. That is the net, not the gross dividend that anybody says, but that's the net of everything. It's going to be 4.455% effectively, because that's basically 100,000. I mean, I'm off by maybe 100th or 10th of a percent or something of that nature, but you get what I'm saying here. It's close enough, right? So you're almost at 4.5% for a net internal rate of return, plus you get all the benefits that go with it. Now, in this, full transparency, you do lose the living benefits, right? When you RPU it, if you go this route. So, but at the 114 at year 10, what happens here? You got 139 at year 10. Now, why is that? You actually have put in an extra $30,000 of premium right here. Now, is that good? You've put in 30,000 more, but what do you have? You have only $25,000 more cash value. So you're still technically kind of a little behind because of the insurance and the term rider and all that stuff. But the way that the dividends scale, you're going to see that this quickly catches up. By the time we hit year 20, we've put in an additional 130,000 in premium compared to the RPU policy where there was only 100,000 in premium. We now have $230,000 in premium, total premium outlay, with $318,000 of cash value and $979,000. So look at this, $230,000 in premium, $318,000 in net cash value. So you're ahead. This is why I always say these are bank accounts on steroids. You're going to get the liquidity because all the money in the net cash value there, you have access to that. So when we compare that, now let's go back over to the RPU at year 20. You got 175. That's still really solid. You've put an extra 130,000 into it, but what do you have? You have, let me do some math here. I didn't write that down. You have 318 minus 175. You have 143,000 more cash value. So you've put an extra 130 in, but you got an extra 143. All right, it's good. It's solid. So the question is, like, the way I look at this is it's a savings account on steroids, like I said. So if we look at that and we kind of come through that lens, and I say, all right, if I'm putting in $1 here, let's take a look over here. If starting year 8, I'm putting in $10,000. Well, if my account's growing by more than I'm contributing at that point in time, but in this scenario, it's growing $12,885. Why would I not keep contributing to that? It's growing. It's like super efficient, right? And so you can see by year 20, that's how it goes. But the thing is, when you fund this, the longer it goes, the more efficient it gets, right? And so by the time we get all the way down here to year 75, okay, remember, this is when I said it was fully paid up, is year 75. You can see that in the full paid policy, you have $757,000 of net cash value with a $949,000 death benefit. Now, when we go back to the beginning of this, and I talked about the fact that the cash value goes up, but so does the death benefit. Now, the term rider dropped off. I just want to be fully transparent there. The term rider dropped off. You can see here, year 20, it dropped off. We did that. Once again, the purpose of this policy is not life insurance. It was cash accumulation. Now, do I think life insurance is absolutely important? And if that were a conversation somebody wanted to have, like, I think we need to maximize for life insurance as much as possible. But, we got to take all the variables into consideration based on, once again, what your goals and objectives are. But now we look at this, we got $757 of premium, okay? So what do we got? $368,000 of total premium. $368,000 minus, okay, 368 minus the 100. So it's $268,000 more that they've paid in premium, okay? $268,000 extra in total premium. And I'm gonna go over here, and I'm gonna go to year 75, and I'm gonna look at the death benefit and the cash value. 322 and $404. So we've got $322,000 in cash value in the reduced paid up policy, which, by the way, you only contributed $100,000 to it. So that's pretty solid stuff, right? Like that's good. But if we paid $268 more and we have $757,000, when I say, all right, let's go the 757 minus 322, which is what the cash value is, that's $435,000 more in cash value, even though you only put 268 in. So that means you come out $167,000 ahead of the additional premiums that you paid from year 7 on in this policy, where you could have stopped, right? But instead of stopping, you kept making that premium payment, right? And from that point on, you paid that $268,000 in extra premium, but because you paid the $268 extra into a guaranteed account that is operating as efficiently as any guaranteed fund is going to work from year 8 and beyond in this policy, you end up with an extra $167,000 of liquid accessible capital that you can utilize for real estate investing, for trading, for business reserve capital, for emergency fund, for opportunity fund, as a volatility buffer, and for retirement income, all these different things. And it's an asset that is going to be the most efficient tax growth asset that you're going to be able to find, right? So when you look at these things and you consider, this is where you could be at year 75, when you're at age 75, you're 35 in the policy, or you could be here. To me, that kind of turns out to be a no-brainer. And then from there on, it just gets better and better. You can see that this one in retirement, from a retirement volatility buffer perspective, this one's growing by almost $30,000 a year at this point in time as soon as it's fully paid up. Whereas this one at that point is still only growing by $12,000, right? So the asset that you've built, the power, the legacy that you could create with the extra life insurance, the flexibility and the power of having the extra capital while you're accumulating during your accumulation years, and how you can leverage it while you're actually working. It's a really, really powerful tool that, and I think it's important to understand, it doesn't make sense to pay the policy up. Now, when we go back to this and when we look at it, and I'm going to actually go back to it for 1 second here, and when we look at the policy here, and we say, okay, if we at any point in time here, in the other one here, you could see we did the RPU at year 8, right? And this is done. This is somebody who decided that. But the bottom line is, we could do that at any point in time. All that flexibility exists no matter what. And so my encouragement to you is to really think about that, really think about the financial efficiency behind this vehicle. And the longer you contribute, the more efficient the money is going to grow, the more efficient of an asset that you have that's going to be able to help you reach your financial goals on a more predictable basis. So I think the answer is, when people ask me, Chris, how long do I have to pay? The answer is, well, 7 years technically, and then you can RPU it if you want to really have a purely paid up asset, which, by the way, this is a unique feature in whole life insurance. You can actually pay up the insurance, reduce the benefit, pay it up fully, and it's a fully paid up asset. With IULs, you can never fully pay up the policy. It's impossible. So it's really important to understand the difference in that dynamic. And I don't think that is spoken about enough when it comes to the flexibility of whole life insurance and kind of the liability when it comes to index universal life. But when we look at this and we think about kind of operating efficiently, pay for as long as you can. At that point in time, you can RPU it, or you can do a premium offset based on kind of where you are at that point in time. But that's just something you got to kind of take on a case-by-case basis and see what makes sense for you. But at the end of the day, what this comes down to is, I think the rule of thumb is, while you can pay for 7 years, you want to pay for as long as possible, and understand that any time between year 7 and beyond, you have ultimate flexibility, right? And I would say even from year 1 to 7, you have some flexibility with the paid up additions and different ways to maneuver your policy a little up and a little down. Obviously, don't stretch yourself to the point where you think it's going to be a huge problem. I would say the only time that you allow yourself those kind of flexibilities is when you run into financial hardship. Maybe you lose your job, maybe something terrible, catastrophic medically or something like that happens to you or somebody in your family. Things like this happen. But I would also argue if that happens to you and you have this policy, there's a good chance that there's going to be a great benefit for you in it as well. So there are ways to do that. If you haven't seen it already, I just did a video on understanding whole life insurance, how it works, and things you need to consider if you're going to be getting a whole life policy. It does a bit of an umbrella kind of overview, talking about the different nuances, the different riders, the different features and policies that you should consider and contemplate if you are looking to do this for yourself. So I would encourage you on the end screen, I'll put that video so you can go watch it. But that's it. If you have any comments, comment in the comment section below. Any questions, do the same. If you haven't already, please subscribe, like, hit the bell. That way you're notified every single time I launch a new video. Share this video out, get it out there to people. I just feel so grateful for the support that the channel's been getting. And I'm just, honored to be able to serve and give information. If you have any questions, if you have any videos, any clarity that you want, any topics, feel free to let me know and I'll do my best to make them and engage. Shoot me an email, chris@life180, any questions. And if you haven't already, go down to the link in the description below, get a free copy of my book, Cashflow Hacking, or if you want to set up a clarity call with one of the coaches on my team, go down, set up your free complimentary clarity call. And that's it. Have a blessed, inspirational day. Till next time. We'll see you then.